Hey everybody, what's up? Time for an update. Yesterday I was very busy, so I didn't have a chance to put out a video, but you're getting one today. All right, let's go back to last year in the lead up to the Fed's balance sheet reduction. Remember that? They announced it, and that was still Janet Yellen was the Fed chair. The Fed said it would begin reducing the size of its balance sheet in October of 2017. They were saying that already, I think in September they made that decision. And everyone went crazy. Everyone was like, oh my God, if they do that, that's going to cause a recession. That's going to bring back deflationary forces and all this high level of worry people were talking about. It's going to be a very contractionary. Now, I said the total opposite, and I was the lone voice out there. I explained that balance sheet reduction, which entails, the Fed allowing the securities on its books to roll off, in other words, just mature, and they would not reinvest and buy new ones. Functionally, that is the equivalent of allowing those securities to remain in the economy, in the private economy. Now, remember, if you go back to quantitative easing, and again, I was the lone voice on this. When everybody said it was going to be hyperinflation and inflation and the dollar was going to crash, I said the opposite. That it was the removal of income. When the Fed was buying those assets, which were higher yielding assets than cash reserves, it was stripping the economy of income, and that was going to slow things down. It was not going to cause inflation. You're removing income, and that's exactly what happened. And I said the reverse is true with balance sheet reduction. The Fed is now allowing those higher yielding securities to stay in the economy. The economy earns that income. All right. And so what happened? Since that time, the Fed's balance sheet is down something like, I think, 240 billion or something like that. And if you look at everything that has happened since then, back in October 2017, the GDP growth rate was 2.3%. Now it's 4.1%. The CPI, inflation, was rising at an annual rate of 2%. Now it's rising at 2.9%. Stock market, the S&P was at around 2,500, 2,520. Where's it today? 2,875. The 10-year Treasury yield was at 2.3%. Today it's around 2.8%, maybe a little bit higher. Oil prices. Oil was at $51 a barrel back in October. Now it's at $69 a barrel. What about gold? What about the dollar? The dollar index, and I'm going to use the Fed's trade-weighted dollar index of major currencies, that was at 88.60. Today it is at 90.60. Gold was at 12.70. Today it's at 12.20. So on those last two, I got everything right. The growth in the economy, the rise in inflation, oil prices higher, rates higher. I got everything right, with the exception of, at least now, you look at what has transpired in gold and the dollar, and those are not off by much. If you look at that dollar index, that's off about 2% since October of 2017, and gold is off about 4% from 2017. But I will submit to you that insofar as gold and the dollar are concerned, they will revert back to their primary trends, which will align with everything that I said that was going to happen as a result of balance sheet reduction. Remember, nobody said that. Everybody said we'd go into recession, it was going to be contractionary, you'd have deflationary forces, all this. That has not happened. Stock market is at new highs. So the understanding is absolutely correct. What we have seen, at least with respect to the dollar and gold, has been a massive amount of speculation. Clearly, if you look at the breakdown in the CFTC's Commitment of Traders report, you see that in both the case of gold and in all the individual currencies, which make up that dollar index, you have major, in some cases, historic net short positions on the part of speculators. If you look at dealers, they are long in extreme fashion, opposite to the speculators. So I believe those two will revert back to their primary trends, which that is gold being up and the dollar being down. And you know, I've been saying this for a long time. But the main point I am making here is that the understanding was absolutely correct, whereas all the very serious people who were out there wringing their hands and fretting and worrying and talking about recession because balance sheet reduction, not only did that not happen, it was the exact opposite as I predicted. A rise in inflation, growth in the economy, major growth in the economy. The growth rate doubled in that period of time. And we are seeing now the stock market break out to new highs, which, from my point of view, is signaling that the last 5-6 months of kind of static data, worries over trade wars, that sort of thing, we're going to start to see a re-acceleration in the economic data. I think the stock market is clearly sending that message. So everything worked out. Everything worked out. You got to be a little bit more patient on the other two things, that is the dollar and gold, but everything worked out. I mean, you know, you got to look at the facts. You got to look at the reality. I had it right. All right, everybody. See you later. Bye-bye.